Dear students, welcome you all to session 16 video of the chapter Capital Structure, Financial Management, 5th semester BCom. In this session, I am going to explain the concept of a debt equity ratio. Debt equity ratio is a financial ratio which indicates the relative proportion of debt and the shareholders' equity which is used to finance a company's assets. This ratio is used to evaluate the leverage of a company. So how can you find out the debt equity ratio? Debt equity ratio is equal to long-term debt divided by net worth. When I say long-term debt, these are long-term secured as well as unsecured loans. Now, net worth. How do you calculate net worth? Net worth is equal to share capital, that is equity share capital plus preference share capital plus reserves and surplus minus fictitious assets. Like fictitious assets like the preliminary expenses, discount on issue of shares and debentures, etc. Now, what does the debt equity ratio convey? Now, a high level of debt equity ratio means the firm has huge debts or more debts in the capital structure than the equity. It has got its own benefits, that is the reduced tax liability, higher earning per share for equity shareholders, etc. But there is one single problem or demerit which actually wipes out all the other benefits of the debt. That is the obligation to pay the interest even when the firm is incurring losses. So nowadays we have firms going for zero debt capital structure wherein the firm need not bother about the payment of interest. So low debt equity ratio is another case wherein the company is relying more on equity than the debt. So in this case, what happens is in case of equity shares, the company need not pay the dividend. That is, when losses are there, company need not pay the dividend. Even when profits are made, it is not compulsory on the part of the company to pay the dividend. Company can go for retaining the earnings. So now we will work out a problem. That is, a firm's balance sheet is given below. Calculate the debt equity ratio. So you can see here the equity share capital is 1 lakh, the preference share capital is 50,000, reserves and surplus nil, secured loans 1 lakh, unsecured loans 50,000, current liabilities 50,000 and the total amount. Fixed assets you can see 2 lakh, current assets 1 lakh, miscellaneous expenditure, there are different items. One is preliminary expenditure, it's 10,000, discount on issue of debentures 20,000, profit and loss account, this is actually loss, so it is 20,000. So the total of the balance sheet is 3,50,000. Now, we will calculate the debt equity ratio. Debt is equal to secured loans plus unsecured loans, that is 1 lakh plus rupees 50,000, 1 lakh 50,000. Net worth we'll have to calculate. How do you calculate net worth? Equity shares plus preference shares plus reserves and surplus minus fictitious asset. So in our the balance sheet which is given to us, we can see equity share capital 1 lakh, preference share capital 50,000, reserves and surplus is not there. And then we have various miscellaneous expenditure, that is preliminary expenditure, discount or issue and profit and loss account. These are fictitious assets, these are not real assets. So 1 lakh equity share capital, 50,000 preference share capital minus fictitious assets. So we have 1 lakh plus 50,000 minus 10,000 minus 20,000, 20,000. So we have 1 lakh plus 50,000, 1 lakh 50,000 minus 50,000, that is 1 lakh rupees. So debt equity ratio is equal to long term debt divided by net worth. Long term debt is 1 lakh 50,000 divided by 1 lakh, which is equal to 1.5. It can be expressed in ratio, that is 3:2 ratio, that is for 3 rupees. The firm has 3 rupees debt for 2 rupees of equity. When I say 1.5, it means 1.5 is to 1, which means that for every rupee of equity, the firm has 1.5 rupees debt in the capital structure. Students, if you have any doubts, please do inform me. Okay, thank you.